Good afternoon, agents. I hope everyone had a fantastic weekend. Welcome to the first Florida Broker Roundtable of 2021. Goodness. Today's topic is going to be converting bad credit into closed deals. And I do have a credit repair expert. Thank you. I cannot talk this afternoon. His name is Israel Catala. Is that correct?
Yes, ma'am. Yes,
okay, Israel Catala. So I have been working some time now with Israel. He has worked with some of my, actually with me personally, and some friends of mine, good friends of mine, and he did a fantastic job. He was recommended to me by one of my friends, realtors, who has used him for many years, and he has done a fantastic job with her customers. So I decided to give him a try, and I was so happy that I had to bring him on and have him share what he has to offer. So Israel, whenever you're ready, please get started. And thank you for joining us this afternoon.
Thank you, Emily. Thank you for that kind presentation. I'm really flattered and really honored to be part of this webinar, part of this forum. And my name is Israel Catala. I'm stationed here in the beautiful city of Kissimmee, Florida. Our offices are here in the beautiful downtown area of Kissimmee, Florida. And our company is called Innovative Credit Group. You can look it up, www.innovativecreditgroup.com. And we've been in the business of credit repair for the past 22 years already. And I'm very honored and very excited when dedicate this much time into helping out people to regain and recover their purchasing power when it involves credit. There's a slogan that I always say, that credit is the wealth of the poor. And due to the fact that many people do not have the purchasing power to purchase a property because it is something of such enormous value, the next asset that the person can use other than cash money or any other asset is their credit. And right now, people say that cash is king, but credit rules the kingdom. So people that have use the acquisition power of credit has to be everything up to par in order for them to be qualified or approved for anything that involves lending. Now, 80% of the population, and even the statistics say that it has gone up to almost 90% because of COVID, have bad credit. And beginning with me 22 years ago, when I was a newlywed, I was looking into repairing my own credit because my money was funny, my change was strange. My credit was so bad that not even in the blood bank I could get a loan.
Goodness.
That it was,
Wow.
I didn't follow the advice of my mom. I was the son of a single mom, and my mother would making minimum wage on what she used to do on a shoe factory. She had excellent credit. She had her savings. She had her retirement plan. She had everything, up and running. And me, my money was, I was broke like a joke, and I was making good money. I was making good money, but the thing is that because of mismanagement and, forfeiting everything, I said that I had everything under control until I tried to apply for credit. And guess what? I had to use always my mom as a co-signer for anything that I needed to be approved because my credit was not that good.
Oh, you had a good mom, because I know I would never do that with my kids.
Yeah. Well, guess what? I'm going to tell you something moreover on on my story, because when I was pursuing to repair my credit because I was newlywed and I wanted to provide a secure financial future for my family, I was pursuing how to get this done. And I was researching over the internet. Back then it was AOL and everything was dial-up. There wasn't high speed internet like now.
Yes, I remember those days.
Yes, and had those big box
those were tough days.
Yes, yes. And I was looking through AOL, through the search engine, anything that had to do with credit. So I bumped into this information on a do-it-yourself kit on repairing your credit and said, oh, good, I found something. And I pursued to repair my credit, and guess what? Applying the strategies in that book, that it was very simplistic, very simple, very user-friendly. In 30 days, I acquired excellent credit with all three credit bureaus.
Wow.
Then I did my wife's credit and excellent credit. And I said, what, wait a minute, is this for real? And then I looked for my mom's credit because I damaged it because of the cosignership, because I defaulted on my loans that she co-signed. I looked into repaying her credit, and guess what? Excellent credit in 30 days. And it dawned on me. So
Yes.
I said, wait a minute, I'm going to start offering this to car dealerships, banks, and all of that. And I became the talk of the town. That was back then in Puerto Rico, when I used to live in Puerto Rico. I converted one of my kids' room into my office, into my home office. But then we moved over here to Florida, and I brought the business with me. Although there was still people in Puerto Rico, calling me, hey man, you left over there, but you could still work on our credit. So I worked on their credit as well. But 22 years later, we are here with thousands of customers that have gone through our services. And of course, we kind of guarantee the same results on everyone, because every person is an individual. And of course, we're not the credit bureaus to determine that you are going to have that same outcome in such a short period of time.
Mm-hmm.
Uh, but of course, we do everything ethically. We do everything compliant to the federal laws. We don't do deceptive type of credit improvement or credit repair because it's against the law. We don't do anything that's like a credit sweep that it's out there. It's a very popular strategy that you do. You follow a fake, a bogus affidavit and a bogus police report, and
Mm-hmm.
say that you are a victim of identity theft when you have not been a
Yes.
victim of that sort. Or we don't do anything on. There's another fad out there that's called synthetic identity theft. That's creating a secondary social security number. It's called a CPN, a credit profile number. We don't do that
Mm-hmm.
either. Everything that we do is ethically. Everything we do is according to the Federal Trade Commission that has regulated or has established laws that are like the Fair Credit Reporting Act, the Fair Debt Collection Practices Act, the Truth in Lending Act, the Fair Credit Billing Act. We use all of those laws in order to enforce them against the credit bureaus when they're not doing anything inaccurately and anything compliant to those laws. So
Awesome.
when we dispute negative items off of people's credit reports, the first thing that we do, upon sign up, is that we sign them up for a credit monitoring program that's either with Identity IQ or Smart Credit. And that credit monitoring program will give the customer, a snapshot of what their credit report looks like. The credit scores are not FICO 2, 3, 4, or 5. That's mostly the FICO models that are used for mortgage lending. The FICO scores that we use, the credit scores that we use are Vantage scores because they're the most affordable for the client. And those are the credit monitoring systems that we use that are compatible with our software. But of course, when our customers graduate, or when we see that they're already in they're credit worthy, or they can get pre-qualified for any type of lending, we usher them to go to myfico.com. That's the most compliant and the most accurate credit scores according to the lending
Mm-hmm.
industry, as far as mortgages, car dealerships, personal loans, and credit cards.
Mm-hmm. Mm-hmm.
And right there, they would see, because upon the removal of those accounts, their credit scores are going to go higher. And it's going to go higher through Identity IQ and Smart Credit. But again, those are not the most accurate credit scores because they're Vantage scores. Of course, we don't use Credit Karma either. We don't use Credit Sesame or CreditWise or any other credit monitoring systems that are used by banks like Capital One, Wells Fargo, or Chase. We only
Mm-hmm.
use these because these are the credit reports that show us the inaccuracies that we need to point out.
Mm-hmm.
So the inaccuracies are as far as anything from personal information, because you could go to the personal information section and you see that there are many surnames, there are many AKAs, there are many addresses, and those are called personal identifiers. Those personal identifiers are the anchors to any of the accounts that are being displayed on their credit. So when we target the negative history, we don't dispute because, oh, it's negative and we are going to ask for removal. No, we look for the inaccuracies and we start with the personal identifiers. Those accounts that are attached to the personal identifiers, as far as the name, misspelling of your name, because let's say that Emily Jarahian is spelled with Emily instead of with a Y, it's a EE, or Jarahian is just with one R, or there's a misspelling on her name. That right there is an inaccuracy that we cannot tolerate in anyone's credit report, because they can mistaken Emily that's being misspelled that way with another Emily Jarahian that uses that name correctly.
Okay.
And that happens a lot. That happens a lot, that a person sees an account that doesn't belong to them and is attached to a misspelling of a name of that customer's name on their credit report. And that's where we start disputing inaccuracies. And we have also, we point out the addresses that are no longer needed on the credit report. And those are the addresses that might be attached to those negative items that we are going to be disputing. And that's the first process. That's the first step. Then we look into the most recent accounts that are being reported within the 2 year, between the last 2 years, because those are the accounts that are eating up most of the credit scores. So we target those accounts and we look for the inaccuracies, anything that has to do with a balance, a late payment, date last reported, date of last payment, date of last activity. When it comes to date of last activity and the date that is being reported, that has to do with the age of the account. So like, let's say there's an account that has been re-aged because the date of last activity is not the most accurate one. When we get it deleted, the customer will see a major impact, a positive impact on their credit, restoring those points in their credit scores because the date of last activity has been removed together with the account. And then we look into anything like payment amounts. We do also, any type of negative listing, from a late payment, 30, 60, 90, 120, 150, 180 days, repossessions, collections, medical bills or medical collections, repossession, voluntary surrender, anything that is negative on the credit report that is reported inaccurately has to be removed. So we target all of that. We target all of that. And also we target the inquiries that are not account holding. When it's a non-account holding inquiry, it means that it's not connected to an open account. There has been people that have been losing, and not in our case, but in other instances or in other companies or even consumers that have done credit repair on their own. They have had their open credit cards that have been in good standing closed because they have been disputing the inquiries. And when you dispute an inquiry, saying that the inquiry was not for financial purposes, was not for credit purposes, this inquiry, I didn't authorize it, guess what? It's attached to an open account. And because you didn't authorize and trying to save your livelihood and trying to save your credit for, from identity theft, so let's close the account together with the inquiry that has been disputed. Now, there has been misconceptions, mostly with real estate agents and mortgage brokers that have encouraged their customers to pay off collection accounts. And because, that negative listing cannot be open in a credit report when it has to do with lending qualifications or lending criteria. Now, paying off a collection account is detrimental because first and foremost, there are collection accounts that do not belong to the person or is not connected to the person. And if the client is encouraged to pay that collection, there's going to be a negative listing or a negative impact on their credit report because a paid collection is as damaging as an unpaid collection. But when you get to pay an unpaid collection, what it is going to do is going to reset the statute of limitations clock, that is the 7-year standing of them reporting in the credit reports. Like for instance, there's an account, a negative account or a collection account that's 5 years old. The statute of limitations in that account is that account is supposed to remain on their credit for 7 years. A collection account is to remain in the credit report for 7 years from the date that it started to be reported. So if the person gets to pay a 5-year collection account that has been reported 5 years from the date that is reporting, they have, by default, they have 2 more years for it to be reported until it is automatically eliminated from their credit. What happens when a collection account that's that old, being paid in full and satisfied as agreed, is going to come up as a paid collection of the credit report? What it's going to do is going to reactivate the 7-year clock to zero, to start to zero again. Mm-hmm. Therefore, the person's credit scores are going to drop. And many real estate agents and credit and mortgage brokers or loan originators have come up to me, say, hey, Israel, I need your help. This person was supposed to close within a week or two, or we just repulled their credit. They're about to close shortly, and we repulled their credit, and their credit scores dropped significantly. What was it that happened? I get to review their credit report, and I see that there's an updated trade line or an updated collection account that has been recently paid for. And I tell them, you know what is the culprit of that score dropping? That account has been paid recently. All because I told the customer to pay it because our lender does not want to see unpaid collections. The best bet for that person to be qualified is to remove that collection other than paying it. Because although the customer has satisfied the debt, the credit score dropped. So they complied with paying off the collection because they don't want to see an unpaid collection.
Yeah.
But then their pre-qualification aspect of having good credit has dropped. So
wow. So what happens in that case? Can you help at all?
That's of course, because the first thing that we do to enforce the removal of a collection account is that we enforce what's called the Section 609 of the Fair Credit Reporting Act. That the Section 609 of the FCRA, or the Fair Credit Reporting Act, states that the collection agency has to prove in original state or in original condition any type of contract that the consumer or the client has signed that is tying them and making them responsible for the payment of that debt. Meaning that most of the collection accounts are purchase debt, or their debt that has been bought in bulk by a collection agency to one of the main creditors that sell those collection accounts in bulk or in wholesale to those collection agencies. They buy it for cents on the dollar, and then they report it on the credit reports of the consumer without the consumer knowing that it is being reported. They haven't received any type of notification by mail, by email, by phone call saying this debt has been transferred to us. Therefore, everything that we are going to do in terms of communication with you is for the purpose of to collect the debt. So the customer says, hey, wait a minute, I made a commitment to the hospital that I will be paying them, or my health insurance will be covering 80% of that. Why am I getting billed because of that? There wasn't a payment arrangement settled. There wasn't anything done with the hospital. The hospital waits for a period of time of 30 days. If that account has not been satisfied, or that bill has not been satisfied, they transfer it to a debt collector or to a debt purchaser without the consumer knowing, and they have no knowledge about it. So we first tell the collection agency, we have no knowledge of this account. We need for you to provide documentation, original documentation with my signature on it. We don't want a computer printout. We don't want a ledger. We don't want a statement. We want original documentation that we are responsible of paying this debt to you. And they have 30 days to do that. If they cannot prove it, they have to remove it. They have to cease their communication, cease and desist their communications as far as collecting that debt, and they have to remove it from the credit bureaus or the credit reports.
Got it.
So that's what we mostly encourage. Now, we do not encourage our customers not to pay any debt, any outstanding debt. We never tell them. We never tell them that because that will be unethical of our part. But we tell the customer, let's wait for it to be removed from your credit. Then it's under your discretion. We don't tell them to pay or not to pay. It's under their discretion if they want to pay or not.
Sure.
But of course, we tell them to pay it after it is being removed from the credit report, because there's no way that it can be reinserted into the credit history again. Once it's removed, they cannot replace it in their credit again. If it happens, and in my time of operating this business, it's like 1% of my customers get re-reported an account into their credit again, but it's because that account has been sold to another collection agency, and that collection agency is reporting for the main creditor. So we get removed ABC, collection agency, they haven't been able to collect the debt, the main creditor or the first party fired that company because they haven't performed well in recovering the money that is well deserved to the first creditor. They hire another, or they subcontract another collection agency, XYZ collection agency. So ABC has been removed from the credit reports, but they could hire XYZ collection agency and they could re-report that account again. And that's a violation to the Fair Debt Collection Practices Act. So they cannot re-report it. And if it's re-reported, we just exercise the same laws against them and we get it removed from the credit. And again, it's not guaranteed, but our dedication and our passion towards our services for our customers get the results.
Interesting. Hey, I want to ask you a couple questions.
Sure.
And if anyone has any questions, there is a chat box that you can go ahead and you can, hold on. Let me see if, okay, yeah, you guys are muted. So you guys could go ahead and enter your questions in the chat box if you have any questions. Meanwhile, I am going to ask you, Israel. So we often get this question. Obviously it's a popular question, and that is, so we recommend about 3 mortgage brokers to our customers, okay, 2 to 3 brokers. So they want to know if their credit score is going to drop every time they get pre-approved.
If they get pre-approved, there is a window of 30 days when it comes to mortgage lending. There's a window of 30 days for them to shop around amongst different mortgage companies. And those multiple inquiries are going to be considered as one inquiry because the system interprets that client is shopping around for the best rate or for the best offer that they can get.
Understood. Does the same apply for a car?
The same applies for a car. For a car, the window of time is 15 days. But if within those 30 days, if the customer applies for a mortgage, they have 30 days to apply for different mortgage applications, and it's considered as one inquiry. But within those 30 days, if they jump over into another industry, like a car dealership, like credit cards, like personal loans, like department store credit cards, if within those 30 days after applying for a mortgage loan, they do that, their credit score is going to drop because it's not within the same industry. Got it.
Yeah. Understood. Okay, and then you mentioned how the 7-year reporting, that it drops after 7 years, and it's 7 years from the time the collection was reported. Yes. I always was told that it was from the last time they made contact with you. So you're saying it's from the date it was reported.
Well, it depends on the listing. Like, let's say when it comes to late payments, the late payment, a 30-day late payment is the first delinquency on an account. That's when the 7-year clock starts ticking. It's not from the date that the account was open. The 7 years start reporting from the first date of delinquency. from the first 30 days late.
Yes. Yeah, I got that part. Mm-hmm.
When it comes to collections,
Yeah.
now when it comes to charge-offs, the same thing. When it comes to charge-offs, the 7-year clock starts ticking from the first 30-day delinquency. But when it comes to collection accounts, collections have never been reported from a first delinquency or first 30 days. It is reported delinquent from the moment it is reported. So the 7-year statute of limitations clock starts ticking from the date that it is reported.
Okay. Understood.
Yeah.
And then, so we know there is a FICO score, right?
Mm-hmm.
And so lenders are going to be looking at the FICO score. Is that correct?
Yes.
Okay.
Lenders will always be looking at FICO 2, 4, 5, and 6. FICO 8 is mostly for cards FICO 8 is mostly for car dealerships and credit cards.
Got it.
But for mortgage purposes, it will always be FICO 2, 3, 4, and 5. I'm a little bit mixed up with 4 and 5, but of course FICO 2, 3, and 6 are the ones that are mostly used.
Now what's the difference between these two? Like who reports on them or what?
It depends on the bank. It depends on the bank which FICO they prefer to work with.
Okay.
But most of the time they will show the same credit scores and they will show the same trade lines, everything that is being reported.
Got it. Okay.
Now,
Go ahead.
Now most people use Credit Karma. Credit Karma is Vantage Score. Credit Karma is not FICO. And of course, Credit Karma is not a credit monitoring company. It is a marketing platform.
Yes.
That's why they lure in and they attract so many clients and so many consumers, because since it is totally free, that's their lead magnet. Credit Karma is a lead generator. So attracting customers for free to look at their credit for free is to bring them in. But at the moment that they're entering into the application, according to the scenario of their credit, they're being offered different type of products, and that's where they start making their money.
Yeah, so basically, kind of like we have the Zillow, and it's like, okay, people contact us. Hey, I saw my house is worth X dollar amount on Zillow, which typically Zillow is about 20% off when it comes to the market value. So how does Credit Karma compare to the FICO then credit score? Is it lower?
Oh no, Credit Karma is much higher. It always comes out to be much higher than the real credit score, the real FICO credit score. So most people, they look at their credit. Oh, I'm in the 680. I could get approved for a home, and they go for pre-qualification with a lender, and they come out. They're satisfied with what they see because it doesn't line up, and it's because they're different scoring models. There are 13 different scoring models in the lending industry right now.
Oh, sure. Nothing could be easy, right?
Yeah.
13. Why do we need 13?
Yes.
Okay. So we do have a question. Question is, can you work with those who have tax ID numbers only?
Well, tax ID numbers are not considered Social Security numbers, and there are not many creditors that work with tax ID, if I'm not mistaken. But if the tax ID is proven to be the 9-digit number that it is displayed on their Social Security number, and they have applied for credit, yes, we can work with that, because that is considered the 9-digit number that instead of being the regular Social Security number, it is considered a document, an official document that will represent the credit history and the financial discipline of the consumer. So if there's negative listings under tax ID, yes, we can.
Okay, so this is a great opportunity for me to ask you about your rent program. Like, as you mentioned, you have a program where you can report rent.
Yes.
Is that correct?
Yes,
to build
correct.
credit. So in this case, you wouldn't be able to do that with a tax ID number.
If the person has started renting the property or any type of residence with a tax ID number, uh, it is, you know, I cannot say no, but since
Uh-huh.
I'm affiliated to this company, and I don't know if the company will use or can use a tax ID number, I will have to research that, and I can come back with to you with an answer that yes, they can work with tax ID numbers.
Got it. Okay,
But
fantastic.
as far as Social Security numbers, yes.
Okay, so tell us a little bit more about that program because I do have a lot of people that come to me that tell me I don't have any credit. How do I start building credit? Because they go out, they try to get, credit cards and loans, and they don't have any credit. So,
Yes. There is what's called the credit mix. The
uh-huh.
perfect credit mix is having at least three to four credit cards or open revolving accounts and
Yes.
2 to 3 signature loans or installment loans. And the difference between one and the other is that one is revolving, one has a beginning, but it doesn't have an end. So we
Uh-huh.
never encourage anyone to close or to cancel a credit card because you are cutting off the life of a good credit mix. And the other, the installment loans are the loans that start with a first payment and the last payment. You see the term loan of 12 months, 24 months, 36 months, 48, and so on. So when it comes to building credit, the person needs to have at least 3 revolving accounts. It could be between uh, uh, open credit cards. It can be department store credit cards. It could be gas credit cards and signature loans. You have anything by personal loans, but you also have car loans and you have rent reporting. So rent reporting is, of course, one of the biggest expenses that people have is their residence. Of course, mortgages are being reported on the credit reports, and they get credit, and that adds value to their credit report because it's showing that the person is paying on a monthly basis on time without missing a payment. They're mortgaged. But what about the rental properties of people that are paying rent? Why not get
Exactly.
credit for that? Because that's,
Exactly.
of course, that's one of the greatest expenses any family has, any household.
Exactly.
So why not get credit? So we started doing, well, we don't do it. We are affiliated to a company for approximately between 5 to 7 years, that this company, they will report to TransUnion and Equifax everything that has to do up to 2 years of of rental history. And if the person has moved within a year, they'll look at where they used to live prior to that, and they report up to 2 years of credit history. And that it would appear on their credit as a rental agreement, but according to the FICO model, it will be considered as a term loan. So there's a first payment and there's a last payment, because everything when it comes to a rental property or anything that has to do with rent, it's based on contracts, and contracts are term loans. So they'll be reporting it as a rental agreement, but also as a term loan. And that could add anywhere from 30 to 60 points. In my case, it bumped up my credit score 79 points in the first
Wow.
in the first time of being reported, and then they report every month thereafter, up to 2 years. And
Wow.
and of course, it all depends on the lenders, on the mortgage lenders, if they will consider that as a legitimate trade line. But it is legitimate as far as bumping up the credit scores, and of course beefing up the credit history if they don't have established credit, or if their credit is too thin. Now,
Yeah.
besides rent reporting, we are also affiliated with 2 different banks. They're not national banks. They're non-conventional banks, and they can report savings accounts into the credit bureaus as if they were term loans, or as if they were installment loans. So whenever you deposit a certain amount every month, they'll report it to the 3 credit bureaus as if it was an installment loan.
Wow.
And again, that will beef up the credit scores because it is adding more value to the mix of proper credit.
Yeah.
So we have that, and we have what's called online shoppers or online department stores that would extend to the customer an amount of a line of credit, like from $1,500 to almost $5,000. Of course, they will have to pay the company a membership, their membership fee in order to be registered, and
Sure.
whatever purchases they make on that from that line of credit, it will be reported on the credit reports. But I always encourage my clients to always make small purchases, because the credit utilization percentage is going to be so low, it's going to add points to their credit scores. And I tell them, do not run that line of credit 100%, because even though
Sure.
it's being reported, the credit utilization, or the DTI to that account, the debt to credit ratio of that account will be high, and it's going to impact their credit score significantly. And of
Yes.
course, we always tell the customers to always keep the balances to their open lines of credit under 10%. We never tell them 30, because 10% it's magical. It's more magical than just 30%. So we tell them, if for every $100, keep your balances under $10.
For every $100.
For every $100, keep their balances under $10. So $1,000, for an $1,000 line of credit, keep it under $100. For $5,000, keep it under $500. So keep it always under 10%. The lower the better, but we never tell them to bring it down to zero, because the FICO system needs to register activity.
Yeah. That's exactly what happened to me.
Yeah.
I was paying it off every month. Yes.
Right. And so if you pay it off every month, it will register at zero. It's not going to add as many points as it should, because they're not registering activity.
Yeah.
They need to see a balance, because the balance will give them the notion, yes, there is activity on the account.
Exactly. Okay, so I know you got to run, but let me ask you one last question. So you mentioned about, and we see this all the time, lenders asking buyers to pay off a collection account. So what's the average number that the credit score will decrease if they were to pay that off?
It will depend. Like, let's say there are 5 different categories in the FICO system. There are open lines of credit. There are credit utilization.
Mm-hmm.
You have the age of credit, the mix of credit, and inquiries. So 35% of the FICO score are linked to the behavior with the open lines of credit. 30% has to do with the DTIs, or the available credit that the consumer has. 15% has to do with the credit mix. The other 15 has to do with with the age of credit, and 10% has to do with inquiries. So if a person pays off an old collection account, 15% of their credit scores may drop. So, like, let's say the person has a 500 credit score, and the person pays off a collection account. It could, and that's an old collection account, and it's a misnomer. It's counterproductive when it comes that you are deleting an old collection account rather than adding points. It takes off points, because it's feeding to the credit score in the aspect of the age of the account. So if the person pays off an old collection account, let's say it's 4 or 5 years old, they pay it off, 15% of their overall credit score can be compromised because of that payment. So if the person has a 500 credit score and they pay off that account, it could drop anywhere between 60 to 75 points. So the best bet will be removal first.
Well, I think if they would have a 500 credit score, they wouldn't be getting a loan.
Of course not. But it's just an example.
Unless they're giving like 50% down or something. I don't know.
Yep.
Oh goodness.
Yes.
Okay.
So
okay.
I hope that answers your question.
Yes, well, here's what's going to happen, okay? From now on, anytime I have a buyer that the lender is telling them to pay a whole collection, I'm going to call you first.
Yes.
And I'm going to have you, look into their credit to make sure that that's the best decision, or at least if, obviously if the lender still requires it, so we could know what to expect. Because, some buyers, they're, you know, if the lender requires, you know, 640 credit score and they have, you know, 650 credit score, then 10 points or, I mean, 11 points would just kill the deal right there.
Yes. Now, the first thing that we do also, Emily, before doing credit repair, we will always encourage the client to apply for or to work on the credit rebuilding program so they could have those points added to their credit scores before anything being removed, and after being removed, they could hurt their credit score. So we encourage them to do the credit rebuilding program first. As far as
Okay.
I have like a list of 10 of them, and I always tell them do at least the rent reporting, the savings account, and one of the lines of credit. Or I forgot to say we have a secured credit card for $200. That it's affordable for $200. You have to secure it with $200. And it's not convertible. You know, it doesn't convert from a secured credit card to an unsecured credit card, and there's no credit limit increase. But it's not. The amount is not important. What's important is that of those $200, there is the debt to credit ratio is low, and it registers in their credit reports as a good standing account.
Yeah.
So we encourage them to apply for those accounts, the credit rebuilding program. If you'd like to know about it, those attendees that are listening to this, you could go to my website. I'm going to type it in the chat box.
Chat box, please.
You could go to my website and you could go to the credit rebuilding section of it, and right there you could see what we're talking about. And as a matter of fact, that doesn't apply only for people with bad credit or no credit. Even people with good credit can apply for that and get their credit scores bumped up, even higher. And you could go above the 800s and make your credit look more attractive than it used to be. So
yes. Awesome. Okay, so it is www.innovativecreditgroup.com.
Correct.
Awesome. Israel, you have been just a wealth of information. I was a banker for 8 years. I did loans, the HELOCs and the line of credit and refinance and things like that. So I am somewhat familiar with looking at credit reports, but it's been a long time. So, and I don't miss those days, to be honest with you. So. I do know that things have changed, obviously, because it's been 15 years since I've been out of banking. So
yes, and to tell you the truth, with me being a credit specialist for this length of time, I am always on the learning curve. I'm always learning something new.
I'm sure.
Because the credit bureaus are always evolving.
Yes.
They're always changing strategies. They're always evolving their operations. So we are updated with everything that they're doing in as far as receiving or reinvestigating dispute letters from our company, and even other companies, are always up to par when it has to do with their operations. Like for instance, there is what's called the eOscar inside the credit bureaus. The eOscar is a scanning device or scanning computer that scans all the dispute letters. And when it scans it, it imports it into the computer system, and the computer system does everything. But guess what? The Fair Credit Reporting Act states that in lieu of a reinvestigation, it has to be done by a live employee.
How about that? Sure, because they're trying to cut employees' salaries.
Exactly. Exactly. And now because of COVID, they have closed many departments. They're short-staffed, and with the volume of thousands and thousands of dispute letters and communications, even through internet, they are inundated with so much work. So they refer everything to the eOscar, but we have ways of how to trick the eOscar and have it landed in the desk of a live employee, and have them execute everything according to our demands. And it's a win-win situation when it comes to that, because when it comes to human factor of having those disputes investigated, the human factor kicks in. They don't want to work. They're lazy. They're getting underpaid. They want to go on vacation already. So, sometimes it works. But of course, we do everything ethically. We do everything compliant to the federal laws. Yes. And yes, we get good results.
Well, listen, I know that you do an excellent job. Like I said, the person I referred to you, not even a month ago or so, she is extremely, extremely happy with your services. I am as well, because I have used them. So, Israel, thank you so much for joining us today. We definitely need to get you back sometime before the end of the year.
Thank you so much, Emily, for having me on board. And whatever questions anyone has, my phone numbers are right there in the chat room. And
Yes.
I'll put in my name so you could have it and you could store it in your phone book. And I'm here to answer any of their questions.
Fantastic. Again, thank you so much. You have a great 2021, you and your family.
Of course, you as well and everyone else. God
Thank
bless.
you. God bless. Bye-bye.
Bye-bye.